Hi, this is Steve Eisman, and welcome to the Weekly Wrap. First, some stats. For the week ending on May 9th, the S&P 500 was down 0.25%, and NASDAQ was down similarly. So the market was basically flat. Of course, that follows the last several weeks when the market had an amazing rally in the hope that the trade war would end in successful negotiations and on the back of a mixed but not terrible earnings reports. It ain't over till it's over. And there was a lot of trade news this week. Trade news began with President Trump on Sunday night/Monday saying that he was instituting a process of creating 100% tariffs on any movies coming into the U.S. that are produced in foreign lands. It was not clear who will pay this tariff or even how it could be calculated, but needless to say, on Monday, stocks like Netflix and other media-related companies saw steep declines. On the other hand, on Wednesday, the Trump administration announced plans to rescind Biden-era AI chip curbs as part of a broader effort to revise semiconductor trade restrictions. Frankly, this announcement was so vague that I don't even really know what it means. And what I mean by that is that the Biden restrictions could be eliminated, but are they going to be replaced? And by what? But chip stocks rallied anyway. And on the other hand, on Thursday, President Trump announced what he called a comprehensive trade agreement with the UK. There were a few details. According to press reports, the deal gives the US increased market access and a faster custom process for exports to the UK, while the UK will see limited relief on autos, steel, and aluminum duties, with many details to be worked out later. Details matter. And at least at this point, this does not seem to be a comprehensive deal. But this is a win for President Trump. It is the first trade deal with a country that he imposed tariffs upon. One potential takeaway from the UK deal could be that no matter who you are, the US is going to charge a minimum 10% tariff, and that includes the UK. President Trump seems to be saying that access to the US is a privilege, and everyone has to pay at least 10%. Finally, this weekend, Treasury Secretary Bessent will begin negotiations with representatives of China on trade. Stay tuned. On the tax front, there was some negative news for those with high incomes. To extend Trump's 2017 tax cuts, some Republicans are pushing for offsets. Late in the week, President Trump proposed a new 39.6% tax bracket for individuals earning at least $2.5 million, and for couples making $5 million. He also wants to eliminate the carried interest tax break claimed by venture capital and private equity managers. Let me explain that a bit. Private equity or venture capital generally take 20% of the profits from the companies that they sell. And that private equity then pays long-term capital gains on those profits, even though they don't invest their own money. For what it's worth, I've always felt that that was unfair, and they should pay an income tax instead of a capital gains tax. That is what President Trump is proposing. It has been proposed many, many times, and private equity has beaten it each time. We'll see if it gets through. On our podcast last few weeks ago, the bank analyst Charlie Peabody discussed the potential issues emerging in private equity because of a lack of monetization. What does that mean? When you invest in private equity or venture capital, you are making an illiquid investment. When a company they have invested in goes public or is sold, that is the liquidity event. The investors in private equity then get back the money they put into that particular company, plus the profits on the investment, minus the private equity 20% cut of the profits. Partially because the IPO market has been so weak for a bunch of years, private equity and venture capital have had trouble monetizing their investments. And this lack of monetization means that investors in private equity and venture capital have not gotten back their money. They are stuck. There was an interesting article on Bloomberg discussing how endowments of Harvard, Yale, and Princeton have gotten impatient and are exploring secondary sales. The article stated that Harvard is in advanced discussions to sell about $1 billion in its private equity stakes, but they will be selling those stakes, of course, at a discount to their stated carrying value. And it'll be very interesting to see what the marks will be on those sales. Before we get to earnings, some other important news happened outside earnings. First, the Fed held rates steady and noted rising uncertainty and stagnation risk. No surprise there. Much more interesting was some testimony by an Apple executive at the Google antitrust trial. Why, you may ask, would an Apple executive be testifying at a Google antitrust trial? It's because Google pays Apple $20+ billion per year to give Google primacy of search position on Apple products. On May 7th, Apple's senior VP of services testified that Google's searches fell for the first time ever in Safari last month as consumers increasingly shifted search activity into new AI rivals like ChatGPT, Perplexity, etc. This would mean that Google's 22-year run of increasing search in Safari has come to an end. Now, investors have been worried for a while that AI would weaken the moats around Google's search business, which is its biggest business. And this is the first truly negative data point. And now, earnings. It was another busy week in earnings, but not quite as busy as last week. Last week, 178 S&P 500 companies reported. This week, it was 94. One lesson of every earnings season for me is that you just don't know how stocks will react because you don't know where investor expectations are. From any objective point of view, this has been a very mixed earnings season with lots of warning flags from companies missing or pulling guidance. There have been some positives too, but a lot of warning signs. But the market has rallied during this entire earnings season. Why? Because the news around tariffs got people so negative, and the market priced in that negativity very quickly. By April 8th, which was when the S&P 500 reached a 52-week low. Even though it takes time for any change in trade policy to show up in results, investors often jump to the worst-case scenario immediately. So it's probably the case that many investors expected much weaker results during earnings season. And so even though this has not been a great earnings season, it's better than the nightmare scenarios some people envisioned. So with respect to earnings, I'm going to divide the results into four groups: consumer-facing companies, media, industrials, and tech. First, consumer-facing. Ford pulled guidance as it warned of a $1.5 billion tariff hit. Clorox lowered the top end of its sales outlook from 4 to 7% to 4 to 5%. They said that, quote, in the quarter, heightened macroeconomic uncertainty drove changes in shopping behavior, resulting in temporary category slowdowns and lower sales. This mirrors the outlook given by Procter & Gamble and Colgate-Palmolive, both of which lowered expectations last week. Molson Coors reported awful numbers. Q1 sales were down 11%, and earnings per share were down 47% year over year. Needless to say, the company missed estimates. The company also cut its full-year growth outlook and said it was reducing discretionary spending and investments in capital projects. The company blamed, you guessed it, macro uncertainty is the reason for pressure on consumption trends. Frankly, I'm not sure this one passes the smell test. An 11% drop in sales sounds like there is more here than just consumer uncertainty. Expedia, the travel booking company. Most, but not all travel-related companies have shown signs of consumer weakness, and Expedia continued that trend. Earnings per share of 40% beat the consensus of 29, but sales of $2.99 billion missed the $3.01 billion estimate. More importantly, bookings only increased in a mid-single-digit growth, and analysts were looking for more. So bookings, a leading indicator, showed consumer weakness. The stock was down 9% on Friday. On the other hand, both Uber and Lyft reported strong earnings with good momentum in bookings. So once again, just like last week, the results in consumer-facing companies were mostly negative, but not totally. Media, Disney, good results. Earnings per share of $1.45 versus $1.21 last year, and versus the consensus of $1.20. So the market was looking for flat, and the company did much better. Disney raised fiscal 2025 guidance, and there was strength across the board, and the stock was up 11% on Wednesday, the day it reported. On the other hand, Warner Brothers reported mixed results. It beat on EBITDA, but there were some negatives like management flagging the rising costs of sports. I include Warner here in this weekly wrap, not because it has much relevance to the economy, but just to note how far a company can fall when the paradigm of its industry changes radically and management does not pivot. Today, Warner Brothers has a market cap of only $22 billion, and Netflix has a market cap of $490 billion. What else is there to say? By the way, in one of our recent podcasts, I interviewed the media analyst Michael Nathanson and discussed these media issues at length. One thing that is clear is that Netflix has won the streaming wars. It has replaced Warner and Disney as the king of media. There is room in the streaming world for other players, and Disney will be one of them, in my opinion, but who else will make it is just not clear. Let's turn to industrials. Here, mostly good news. Rockwell, the maker of automated manufacturing machinery, this is an infrastructure play and would benefit enormously if President Trump is successful in bringing manufacturing back to the U.S. Company reported basically a flat year over year in earnings, but they raised guidance a little bit because of cost cutting. So the stock was up 12% because expectations were so low. So I wouldn't read too much into Rockwell results for the overall economy because the company has been having problems for quite a while. Johnson Controls, an industrial company that provides building products and fire safety solutions. They reported slightly better results and raised guidance a touch. Orders were up 4%, so results were fine, but Johnson Controls, like Rockwell, is hardly hitting the ball out of the park. EPS should be flat this year. Emerson Electric, an industrial company that will also be a big beneficiary of onshoring. Good results. Revenue was slightly better than expected. It reported earnings per share of $1.48 versus $1.36, and the estimate was only $1.41. They kept their guidance for earnings roughly the same, and they're expecting revenue to grow something like 1.5% to 3.5% this year. So again, results were fine, but hardly explosive. And finally, tech. Marvell, a semiconductor manufacturer. This is not an NVIDIA. It makes traditional chips. The stock was down after it reported. Company stated that it was narrowing guidance for the year. By the way, when a company says it's narrowing guidance, that's a euphemism for it's taking guidance down a little bit. And more importantly, it postponed its investor day, citing, wait for it, macro uncertainty. Good guess. AMD reported better than expected earnings after the close on Tuesday. It beat by 2 cents, and revenue came in slightly better than expected. And it also provided better than expected June quarter guidance despite the macro environment. However, the company also said that export controls would cost the company $1.5 billion in revenue this year. And that is why the stock's performance post-earnings was somewhat muted. It was up less than 2%. ARM Holdings. The company designs and manufactures semiconductor technology. It gave a disappointing sales forecast for the current quarter, creating concerns about a tariff-based slowdown for the chip industry. And it decided not to provide an annual forecast because of, you guessed it, tariff uncertainty. Stock was down around 6% on this news. That's the weekly wrap. See you next Friday. Also, we have a great guest on our podcast that will drop Monday. I interviewed Ivy Zellman, the famous housing analyst. Ivy picked the top of the home builders in 2005 and the bottom in 2012. We will be discussing all things housing. Thank you so much for tuning in. For video episodes of this podcast, head over to our YouTube channel. If you're listening on a podcast platform, make sure to follow the show so you never miss a new episode. And if you got something out of today's conversation, we'd love for you to leave us a 5-star review. It helps us reach more listeners just like you. For links to our website, social media, and to sign up for our newsletter, please check out the show notes of today's episode. On that note, I'm Steve Eisman. I'll see you on our next episode. Quick disclaimer, nothing on this podcast should be considered an investment or investment advice. Guests and their hosts may have positions in any of the stocks mentioned in this podcast. Please do your own work and consult an investment advisor. This podcast is produced by Collier Landry for Don't Touch My Radio and Steve Cohn for Next Horizon Media. Copyright Stephen Eisman, Farseer LLC.